There are two things when you're an investor that you need to look at for compounders. One, you need to understand what's deeply special about the company and why it will persist. And then two, you often need to be willing to pay a premium multiple.
What about the broader market, and will it broaden?
You have to understand kind of how we got here, because I think it informs the future. So how did we get here? The cloud was a big disruptive technology. When I think about the lessons that I learned that shaped me, when you see something special, be bold. Be bold with your projections and be bold with your patience. You want it to have an impact.
Today, we have Anne-Marie Peterson joining. She's a portfolio manager based in San Francisco, been at Capital Group for 19 years. Welcome, Anne-Marie.
Well, thanks for having me, Mike. It's nice to be here with you.
So, Anne-Marie, some people know what they're going to do very early in life. My oldest son, Wyatt, who is 26, he told me when he's 14, I am going to be a teacher. And of course, I said, you're 14. Good luck. You have no idea what you're really going to be. He's now, as I said, 26, and he's a teacher. He had his master's in special ed, and he's been a teacher for 4 years. You, on the other hand, did not know what you wanted to be. So how'd you get involved in our business?
Yeah, I had no idea. So I graduated from college and I traveled for a little bit. And I came back and I decided, I want to move to San Francisco. And my parents are like, great, get a job. You need to pay the bills yourself.
Free.
Yep, not free. So I went to San Francisco, and the first job I got was an assistant at Montgomery Securities to a research analyst. And I didn't want to be a secretary. That was not my life's aspiration. But I figured, gosh, I'll learn something. It was a young, vibrant firm. I'll meet some people. And that actually happened. I learned a ton. The analyst, John Weiss, that I went to work for, he didn't use a computer. So he had me type all of his research reports and his earnings models. So I learned by osmosis. And then he had me doing some primary research, calling stores to see how many golf clubs would be selling, et cetera, et cetera. And I learned the importance of, on-the-ground research to investment outcomes. And so I learned a lot, and I liked it. And then I also met some people, including my husband of 23 years was my office mate.
Okay. That's a fact you kept from me.
Well, surprise for you.
Surprise. So you go from an assistant to an analyst, and you become the youngest partner at Thomas Wiesel at 28 years old. So maybe you didn't know what you wanted to be, but you certainly knew what you were doing.
It revealed itself. My path revealed itself. Well, so I was quickly promoted to a junior analyst, and I liked that, but I kind of had this feeling like, I want to go do good in the world. I should work for a nonprofit. So I quit my job, and I went to South America to teach English and travel. And I came back, same deal. I had no idea what I wanted to do, and I had no money. John called me and asked that I'd come back and work with him. And I said, sure. I really liked him, and I liked the work, so I'd buy time. So I did this. And then, shortly thereafter, he said, I'm retiring, and you're taking my job. And I said, what? No. I don't want to do this. I don't know if I can do this. This is not my plan. But again, I didn't have another option. So I thought, gosh, I threw myself into it. He introduced me to all of his clients, kind of set me up for success. And I threw myself into it. And turns out I loved being the senior analyst. I loved picking stocks. I loved, sleuthing, the primary research. I loved the relationships with the company managements and the clients. And it turns out I was pretty good at it. I was quickly made a partner. The firm was a meritocracy, so if you had impact, it didn't matter where you came from or what your age was. Tom Wiesel made me a partner, and I was grateful for that.
That says a lot about you. Then you meet Greg Wen. So Greg Wen is a portfolio manager at Capital Group. He's been here for about 35 years as a PM, and you meet him. And how did that end up with you coming here?
So, Greg was a client, and he became a friend. We both live in San Francisco. Right. And he called me at one point and said, would you be interested in interviewing at Capital for the analyst job? And this time I knew exactly what I wanted to do. That is, I wanted to come to Capital and I wanted to invest. So 30 interviews, and 1 year later.
That's it?
That's it.
Just
I got
30?
the job.
Yeah.
No, I actually called him during the process, and I was like, Greg, hey, if it's not working out, that's cool. Like, I get it if they don't want to hire me. He's like, no, it's going great. You're on 15. You only have 15 more to go. So anyway.
Now that you've been here for almost 20 years, you've learned. That's
a lot of due diligence. But so I got the job, and I'm grateful for him. He saw potential in me. Grant Cambridge and Brad Vogt hired me.
Okay.
And I'm really happy to be here for almost 20 years. It's been a great experience, and I love investing here. I love the people. I love what we do.
So one of the first stocks you looked at, Home Depot.
Mm-hmm.
And Home Depot, when you started looking at it, was in the 30s or 40s.
Mm-hmm.
And today, 20 years later, it is literally 10 times that share price.
Yep.
Something in the mid to high 300s.
Yep.
Tell us a little bit about Home Depot and how it influenced your investment process.
It was formative. It sticks with me today. So first the story, and then I'll tell you how it formed me. It was 2009, middle of the housing crisis. I was the new retail analyst, and the PM said, "Hey, this thing's beaten up. Take a look." And this has every characteristic of a bad stock. You're in the middle of a housing crisis. The stores are maturing. They don't have systems and supply chain. And you had a leadership crisis. The founders had brought in a few years earlier a professional CEO, and that didn't really work out. They ousted him, and they put in place a CEO named Craig Blake. And on paper, he looked horrible on paper. He had no retail and no operational expertise. Begrudgingly, I went to Atlanta to meet the guys. I had already written the report. Don't bother with this stock.
Right. Too much going wrong.
Too much going wrong. They're just checking the box. And then I sat down and I met with him, and he kind of blew me away. And I didn't want him to, but he did. So for two reasons. First, he talked about the importance of culture as the foundation. That's where he started. He wanted the company to bleed orange again. They had these orange aprons that they'd wear. Their motto was bleed orange. He brought back the founder, Bernie Marcus, to talk about just the core principles. And really that started reviving the culture. And the second point is he had a pretty provocative growth strategy that basically fit the fact that the company was at a different phase. So he said, and it was counterintuitive but profound, we're going to stop opening stores, and we're going to reduce CapEx, and we're going to focus on getting more out of existing stores, and we're going to fix the IT and build a supply chain. And it's hard to express how difficult the fact that they didn't have systems and they didn't have a centralized supply chain as the second largest retailer. This looked like impossible tasks. So I was intrigued. And there was a moment in that first meeting where I had the thought, he might be the right leader for the right time, and this might be outstanding. And we were sitting there, and I was pushing him. I don't understand why you're going to build your own internal system. You don't even have systems. Why not use SAP like all the other retailers? And he said, yeah, no, I know. We're worried. I'm worried. And so I was like, well, this isn't confidence inspiring. And then he points to a room next to us and he said, Anne-Marie, if I built a ship in that room, but I couldn't get it out the door to sail, what use would that be? His point, SAP does not fit our business. We have no other option than to build our own systems. And that's when I knew he deeply understood the guts of the business, number one. And number two, he was going to be bold but careful.
So he was building a strong foundation. He was really saying we can bypass growth right now, get the foundation right, and we'll be growing off a stronger footprint thereafter.
That's right. And what happened was the stock performance that you just mentioned, that was all driven by free cash flow growth. It unlocked the best sales growth in the company's history, same-store sales, the best profit growth. They bought back 3 to 4% of shares outstanding while growing well above average. So it was a home run. So when I think about the lessons that I learned that, how shaped me, one, strong culture and strong leaders drive outcomes. I focus a ton on that. The second point is be open-minded about growth levers. They change as the company changes and evolve. The third point is when you see something special, be bold. Be bold with your time. Be bold with your projections. I had an estimate that, after I did all this work, I cleared the deck, I did a bunch of work, and I said, I think you're going to earn in a couple of years like 2x what people are expecting. It sounded crazy, but that was the bottom-up projection. Right. And then be bold with your sizing and be bold with your patience. You want it to have an impact. And then the last kind of a way it shaped me is the importance of relationships. from Frank, I learned actually how a company really worked. That informs me today. I deeply understand how companies work. But he also learned from me, and I want to close with the Home Depot topic with a little story. So a couple years into our investment, he called me and he said, hey, I'm going to be in San Francisco. Can I take you to lunch? And so I show up and I said, hey, why are you here? And he said, to take you to lunch. I said, what? He's like, no, I'm nothing. I'm here to take you to lunch. And I'm flying back. I said, well, wait, why? And he said, well, let me tell you a little story. I told myself if the stock hit $60, wherever I was in the world, I would drop everything and take you to lunch. And he said, when you made the first investment, I had to, shortly thereafter, I had to speak to the store managers. And the store managers have stock options. And he said, I had to tell them that, give them some inspirational speech. The morale was low. And he said, no, I doubt it. I didn't even see it. And he said, so I used you. I said, there's an investor in San Francisco. She thinks the stock's going to $60 for these reasons. I used you for inspiration.
Wow.
And it happened. And I realized, I was so blown away by it, one, that he would come take me to lunch. But I hadn't really understand that it's kind of a two-way street and the importance of the relationship. So Frank's been retired for 10 years. He and I remain close. We talk frequently, and he's been a source of learning and kind of joy for other things. You've met Frank.
Well, and he also laid the foundation for something that didn't just go to 60, but went to 360.
That's
so
right.
Not all under his watch, but you can't build a house on top of a bad foundation.
Yeah, that's right. And when he left, I spent time with him, the new guy, and you realized, wait, this is just, he was act one. There was this even more powerful act two and act three after that. To your point.
So you spend a lot of time with management. It's one of your superpowers.
Mm-hmm.
And you talk often about the importance of management, meeting them, getting to know them, seeing what really drives them. How do you think of managements and also long cycle compounders in the same mindset?
Well, I'm glad you combined the question because the two are intertwined. You can't have one without the other. So a compounder, this is how I define it. It's a company that's able to have consistently above average persistent growth for very long periods of time and turn that into high free cash flow and have high returns. So this is really rare, right? And there are two things when you're an investor that you need to look at for compounders. One, you need to understand what's deeply special about the company and why it will persist. And then two, you often need to be willing to pay a premium multiple. People will say is, oh, it's expensive, it's understood. But what's not understood is these things are rare. When they happen, the stocks compound with earnings and they maintain premium multiples. So there are three characteristics of a compounder. And let me explain it through an example.
Right.
Costco. The first one is they have very strong cultures. Costco, and they're obsessed with the culture is obsessed with providing this great value proposition to a consumer, whether it's a product or service. It can happen in any industry. So Costco, when they were founded, they were like, look, the founder said, I want lowest possible prices, highest possible quality for our customers. And this is how we're going to do it. We're going to ask customers to pay a membership fee to shop in a bare bones warehouse with minimal service and 2 selections in each category. Who would do that on paper? Nuts. But it actually worked. And the business model reinforced their ability to offer great values, high volumes, low markups, low cost, high free cash flow, high returns on capital. And they could pay their employees more than anyone else. They paid above minimum wage. So that's the first point. The second point is you have to be willing to say no a lot, and you have to have quirky practices. So let me give you the example. Costco. In retail, there are all sorts of temptations to take a little more margin here and there to earn more, and Costco just constantly resists that. In the 1980s, they got this buy. I love this story. They got a buy of Gloria Vanderbilt jeans, super hot fashion at the time, and they were selling in the marketplace for $80. And Costco put their 10% markup on it, and they were like, oh, look, they're $29. There wasn't even a discussion. Well, maybe we could sell them for $35. I mean, it's still well below $80. Nope, that was that. They're religious about it.
Discipline.
Very disciplined.
Yeah.
It's not even a question. And then the food court, their little symbol is the food court hot dog. It's $1.50. It's always been $1.50. It always will be $1.50. And then the third point, getting to your question about management, not only do they set the foundation, Mike, for the culture, but they also have to be willing, they have to understand, the next generation has to understand what's special. And they have to be willing to stick to it and protect it. It's really easy to stray. And so I was recently in Seattle with our analyst meeting, the third incoming CEO. And I just thought to myself, in one way, I was like, why am I here? This is the same meeting as we had 15 years ago. And this is exactly why I'm here.
It reinforces.
Yeah, he's not going to change a thing.
I'm going to pivot into our office treasure hunt. And in this box, I have something from your office, and it's probably strange to take someone's footwear.
Yeah.
But that didn't stop me. So could you tell us what this is?
Yeah.
For those who are listening, not watching, what is this?
Well, it's a beaded moccasin. It's vintage. It's white. It has lots of beautiful colors. And it's special to me for two reasons. One deep and one a little superficial. The deep reason is it reminds me of my summers in North Dakota as a child, spending time with my grandparents. My grandparents' families immigrated from Norway. My grandparents lived in this little town called Mandan on the Heart River. And Hanson Elida, my grandparents, wonderful people. And the day school got out until the day school started, I'd go back and me and my 5 siblings would spend the summer with them. And it was a really happy time. I loved the area's rich with history of the indigenous people. And when I was a kid, I loved history and I loved reading. So I spent my summers reading a lot about people that lived there. And when I saw these, they reminded me of that. And then the second point is I have a shoe obsession, and these are beautiful shoes.
Do you wear them in the office?
You know what? I have big feet, and they're a little too small.
They're a little too small. Okay.
But.
Well, I'd love that you think about your childhood when you see them. I mean, childhood memories like that are great.
Yeah, it's always important to remember where you come from.
Absolutely.
It makes me happy.
Absolutely. I have a old license plate in my office from 100 years ago from my great-grandfather. It just reminds me of Connecticut growing up and those kinds of things.
I love that. Yeah, the little tells, the symbols.
So let's get to the market. The market is beginning to broaden.
Yeah.
And has an opportunity to probably broaden even further. Before we get to individual stocks, lessons learned, things like that, what about the broader market, and will it broaden?
Yeah, well, I think it's a yes and. I think you'll continue to see some concentration in certain areas probably, but you will see some broadening too. But, I often think the past informs the future. And I think you have to understand kind of how we got here, because I think it informs the future. And so how did we get here? The cloud was a big disruptive technology, and it enabled a few companies to grow really fast for a long period of time and be really profitable with minimal CapEx. There's fundamental underpinnings to how we got here, a new compute platform. What's interesting about the companies is you have the megas, the big ones that got really big, but then you have some second derivative beneficiaries. And then what I'd say, you have kind of everything else the world goes on. So there's 3 categories. I think that you'll continue to see 3 categories. But what's interesting to me about the past is the megas were old companies, Microsoft and Apple. Microsoft used the cloud to they built the cloud and had software monetization that was possible, wasn't possible before the cloud. And then Apple had expertise in hardware, and they leveraged the technology to basically develop a device that's our appendage. And then you have some middle-aged companies, Amazon and NVIDIA. And Amazon created the cloud, and the only reason they created the cloud is they needed it for e-commerce. Turns out that's the crown jewel. And NVIDIA was creating graphic processing units for video games. Turns out that's now the foundation for AI. And then you had some new companies that were born in the 2000s. So the early were born in the 80s, the kind of middle-aged born in the 90s, and the 2000 companies, Google and Meta, and they just leveraged the cloud for social media and search and monetized it with advertising. So, but even with that over the last decade, what you saw second derivative beneficiaries. What happened? Semis got more complicated, and the industry consolidated. Avago was a $20 billion market cap a decade ago. Today it's $800 billion. Okay.
Wow.
Wow. right? We talked about Costco. That was an outstanding stock. Amazon, the last 5 years, it's actually been better than Amazon. And then you have the luxury goods companies. E-commerce enabled them to have more reach. Social media expanded the customer appeal, and those were outstanding stocks over a decade. And then you kind of had everything else. I mean, there were a bunch of other, like Eli Lilly. That's been one of the best stocks over the last decade, especially over the last 5 years. Chipotle continued to open more stores. United Health had to serve more customers. So I kind of think about that as a framework for the future. So where are we now? When you look at the big megas, the market's saying, gosh, NVIDIA is the next compute platform. Usually the first compute platform that emerges stays the winner. And it's interesting when you look at the hyperscalers because they're getting more capital intensive and competitive. So the questions that we're asking are, can they continue to grow and be such great businesses, right? And then you kind of have the everything else, or you have the second derivatives, which are, gosh, chip designs are getting more complex. More companies are designing chips for their internal use. Synopsys is kind of interesting. It's an $80 billion market cap. Could it be bigger? Maybe. And then there's everything else. GE and Safran are still building aircraft engines. It has nothing to do with AI. Old Dominion Freight Line is still basically delivering goods, at the last minute, superior service. I mean, you could kind of go on and on.
Everything else category keeps...
The world keeps going on. There are these big themes. The market gets obsessed about it, but it's a big, wide world. And that happened over the last decade. I suspect that'll happen over the next decade. But the last point I want to say, Mike, is what's underappreciated about this is as active managers, it's our job, particularly in the income funds, when there's a change, there are new winners and there are some big losers. And we can actively avoid the losers. We have the research engine to do it. We see the companies. We bat this around all the time. And right now we're at this stage where I feel like something's changing. There's some things that are clear. There are a lot of things that are unclear. But we're asking the questions. We're putting ourselves in the position to see the opportunity. So I'm excited. I haven't been more excited about stock picking in a long time.
Excellent. So you and our other investment professionals tend to be very humble. And when I ask the question of, tell us about a lesson learned where the stock didn't do what you thought it might do, you all say, well, there's too many to count, but I'm going to ask you to count one.
Okay.
So give me a lesson learned on where something went off the rails and didn't come back on.
As an analyst, my mistake was Starbucks. It was a success, and then it became a massive mistake. So it was the first big call I had. I came in and I said, wait a second, there's something wrong. We owned Starbucks for a long period of time. They're overexpanding. They have too many stores. The multiple's high. I think growth's going to crack. Let's sell it all. Controversial. It ended up being right. The stock went down. We sold it. The stock went down a lot. And I was like, yay, I'm so smart,
Wait for it.
Wait for it. And so then PM started asking, God, it's looking cheap. Is it time to take a look? And I wrote this report. Starbucks, is it a value or a value trap? It is a value trap, definitively, please avoid. And it kind of was for a while. And then something interesting happened. The company came out and said, Howard Schultz, the founder, we're going to close 10% of our store base, take a charge, focus on our existing stores, get more out of them, reduce costs. And PMs were like, is it time to take a look? And I was like, no. And stock went up 8x from there over a decade. Wow. We didn't own a single share. You know what the lesson was? One, I learned that I was wed to being right in the past. My job's to be right in the future. So have a more open mind. I know that about myself. I kind of dig my heels in. And then the second thing is it actually kind of put me in a position to see Home Depot. This happened a few years before Home Depot, and they had this extraordinary period of growth that I missed that came out of closing stores and stopping growth. And so I kind of saw that.
So when something changes, you have to change.
To change and just be open-minded at change. Just revisit everything, re-underwrite everything.
In terms of investment edge, the other side of when it doesn't work, what's your investment edge? Is it understanding managements where we were before, where we were talking about how you really interview them and understand them well? What is your investment edge?
Well,
you have a bunch.
Yeah, no, I think I had to boil it down, Mike. I love that you're asking me this question because it kind of makes you really think. But I think it's first of all, it's important to have an investment edge when you're a portfolio manager because it's a really broad world. And so you need to have some filter to like narrow where you spend your time. And I think my edge is seeking edges or seeking some sort of extreme or outliers, seeking the deeply special. I've always liked to do that. I kind of avoid the middle. If something is in the gray area, it just doesn't excite me. I don't want to spend time on it. So I kind of like look at the edges in a couple of ways. I kind of see that they're fundamental edges, where a company's either early stage growth. You can grow fast early on, but sustaining that's rare. So trying to find the one that can sustain, whether it's these middle-aged companies like Home Depot where there's a new life, again, rare, or whether it's a compounder. I talked about it. I just like finding deeply special. And then I also think like valuations are edges. Like I like extreme multiples. Really high tells you something super special is happening and it's going to continue for a long period of time. Really low tells you, moat's deteriorating, something's really wrong here. So I like kind of figuring out what's wrong there. So I spend a lot of time on, and then the culture and people edges, like strong leaders, strong cultures. The longer I do this job, the more I realize super rare. So I spend a lot of time on that. And then, Mike, I'm also pretty open-minded. I don't know if it's how I started or, what, but I am not wed to where the stock price has been. I'm really interested where it's going.
Right.
Some of the best investment decisions I've made is when the facts change, I buy up. When the facts change, I buy down. I don't get like overly wrapped around the axle. So I think that's an edge for me too. I think I can some people get a little more stuck in that. It hurts me, but it also helps.
And some of that probably comes back to the Starbucks example from lessons learned of when things change. And I think that's great.
Totally. And often, I'd also observed sometimes when the stock goes up a lot in the near term, it hasn't gone up enough. Right. Because something's changed that's profound, that's sort of underappreciated. And this is where our long-term edge is super important because we have a long-term edge as an organization and we have a multiple perspective edge. You can get lots of opinions on the table to help you make an informed decision, both bull and bear. So.
All right. Capital Group mentor.
Yeah. Well, I've been blessed to have many over the years and at present, but the person I want to talk about is Alan Wilson. And
previous guests on this show.
Previous guest. And actually,
yeah.
When I was listening to his podcast with you, Mike, I realized his investment edge is his people and mentor edge. And what I mean by that, so when he said like his superpower is to like look at a company and redefine it in kind of a quirky way, get to the essence of it and do it with analogies. Well, he does that with people too.
Yes.
It's like he just sees things that others don't. So I'll give you two examples. When I was an analyst, at one point I was sitting talking to him about, my favorite stocks, Home Depot. I had just 3 of them that I like, Costco, Lululemon, Chipotle. And he said, Anne-Marie, you are tripping over gold rocks to find gold boulders. And what was his point? His point was, I had a lot of gems in my coverage, and I was only focused on a couple. Well, you know what? He was right. And I embrace that. His superpower is learning from special. I'm like, okay with that. And then once, and as a PM during COVID, when I was a little lost, I called him and I was sort of distraught and I was asking him for advice. And he said, Anne-Marie, you love to be in love. And his point, I was forcing it. He said, let it come to you. Be patient in finding love. You can't force it. So
it's true in many things.
Yeah. So anyway, it was just like helpful for me. I always think about that. I'm like, am I really forcing this? Do I want this to be the thing? And it's being aware of.
He's a good mentor.
Yeah, he's a good mentor that way. And then the second point about Alan and why he's such a special mentor is he is an incredible listener and he has endless time for you. I can't tell you how many times I've called him to ask something. 2 hours later, we're on the phone. Like, does this guy have a schedule?
No
Does
one
he have
walks
a calendar?
the halls better than Alan.
No
one walks the halls
and he
better.
listens so deeply. And then you can tell he listens because he's silent. And then he asks this just like zinger question, which tells you, yeah, he was absorbing all of that. He was formulating it. He cut to the essence of it. And I can't tell you how much he's helped me. Plus, as he's awesome. He's like a friend. He's fun.
Yes.
He's creative. He's smart. He's irreverent. He's great.
So Wiley and your 2 teenagers, what do you do for fun?
Well, we live in San Francisco. It's kind of hard to get. They're busy. They have friends.
They're teenagers.
Teenagers, But one thing that we've been doing for a long time is volunteering together. We try to do it most weeks. And sometimes it's like pulling hair, but we all leave kind of better than we y'all leave feeling like, gosh, I got so much more out of it than I gave. And our favorite place is this place called City Hope. It was founded by a friend. It's in the Tenderloin. It's like 5 minutes from our house in San Francisco, but a world away. And it's a community center for the homeless. But what's interesting is the founders' philosophy is that, look, transformation happens when you treat people with dignity and respect and in loving relationships. So the whole thing's set up about that. So what do? We serve dinners. We used to serve breakfast Saturday. It's too early for the kids now. So we serve dinners, and they have a couple dinners a week. They have karaoke night, movie night, trivia night. I mean, the community comes together at these tables, and we wait on the tables.
The four of you do it together.
Yeah. Wait on tables. We bus the tables, and you have to say the client's name 4 times. Every time. That's the thing. So how's it?
Recognize them as a human being.
How's it going, Mike? Do you like your burrito, Mike? Can I get you some more coffee, Mike? Would you like dessert, Mike? And we've actually become friends with some of the clients there. It's really special. So it's but to be honest, it's such a heartwarming place, and it's heartbreaking at the same time. But I think it's important to put yourself in the position, and I feel like it's important to teach your kids that you're here to give back.
The other place I know you give back is the Boys and Girls Club of America. And I know that because you and Tim Armour, our retired CEO, got me involved.
Yeah.
Can you talk a little bit about that?
Yeah. Well, I mean, it's sort of the trifecta of like head, heart, and personal experience. And let me start with the heart first. So Tim asked me to judge for the Boys and Girls Club Youth of the Year during COVID. And boy, that really got me. I mean, the stories, you'd read the essays of these kids who were graduating from high school, and they gave us speeches about kind of what they were planning to do, all to get earn a scholarship. And every single one of them was deserving. But what the common threads were, just dark circumstances, incredible resilience of the kids, and then the Boys and Girls Club stepping in as that support system that, our kids take for granted, right? I mean, and it's pretty amazing. And I remember the 2 stories stood out. One of the girls was homeless her whole life. Another one had been abandoned by his parents at 10, okay? A boy had been abandoned by his parents at 10. Yet all of them, every single one of those 2 kids, they found time to volunteer as teenagers, and part of their life path was to give back. So that's the hard part. The head part is Wiley and I have this bias toward local organizations. I always sort of feel like, national organizations, they can't have an impact. But wow, Boys and Girls Club is in the category of special. They were founded in 1860, Hartford, Connecticut. So they've endured, and they've figured out how to combine the best of national scale with local empowerment. The company that's done that and is very special is McDonald's. They're the only one in the industry that scaled globally and persistently. So there was something special there about how they deliver the service and the impact. And I just, I had an open mind about it, like I try to do with stocks. So I, joined as a trustee, and I really love that.
It's a great organization, and in the moment of gratitude, which we'll end up with, I am grateful for all of the folks who give time, whether it's time or resources or energy, to any charity. Boys and Girls Club for both of us is really important, but there's so many great organizations globally. And for all the folks who spend time doing that, I am grateful for. And I'm going to give you your very fancy, obsessively grateful mug and ask you get a present, and I'll ask you for what you're grateful for.
Well, I'm grateful for my mom, Jane Lillistrand, and her optimism. And she is one of the most optimistic people I know, always believing in her kids, always has something positive to say, always speaking, just always smiling. And when I was young, I thought it was pretty naive. I mean, she was optimistic when the situation often didn't warrant it. And as I've grown older, I see the wisdom in that. And I feel like it's sort of infected me. I'm not as pure as she is. I definitely have a little bit more of a pessimistic edge. You kind of need to as an investor. But, as I realized, gosh, this optimistic spirit that I have has led me where I am. I didn't overly engineer my career. I just sort of took what was in front of me and thought it would work out and worked hard. And wow, it did.
It certainly has worked
It did
out.
with work. I'm so grateful. And it did with my personal life too. And, as I think about it, even as an investor, it shaped how I invest. The skeptics always sound smart. I am not a skeptic. I mean, you have to be a little bit. You know how you do a great job for the shareholders, particularly in the growth funds? You find special people doing special things that will make the world better, and those produce extraordinary outcomes.
Agreed.
You will make mistakes. And then just being an optimist, I mean, it's just like kind of a more fun way to live your life.
It's a lot more fun.
Just be happy.
Right.
Like something bad happens, I'll grow. And so I also kind of, when I look at our analysts and other investors, I always try to like find the best and believe and kind of, sometimes you're going to be wrong, but it's a small tax.
Yeah, well, being optimistic is a pretty good thing to be. We'll leave it there. Thank you.
Oh, thanks, Mike.
I loved having you on.
No, I love being here with you. Thank you for having me.
Thanks for joining us. And please subscribe to Capital Ideas on YouTube or wherever you get your podcasts. Have a great day.